Been a while since we did a video, so let's do a little update here on markets. Today we had the CPI report. Pre-market, it came in cooler than expected, 0.2% for the core, whereas the expected was 0.3%. And assets rallied, equities rallied, bonds rallied, commodities rallied, precious metals rallied. It was our contention in this week's newsletter that in order for equities to rally, interest rates had to fall. But they couldn't fall because of growth slowing, because that would be bad for equities. They had to fall because of inflation moderating, in our opinion. And today might have been the first step in that process. We had cooler than expected inflation, and equities rallied. However, there were some red flags during the day today where it's not clear that there will be much, if any, follow through in subsequent days and weeks. We'll have to see, but we'll get into some of those red flags. Let's take a look here at equities. We'll start with equities. Here's the S&P 500. In the bottom two panels, we have the relative strength index, and we have the cumulative advanced decline line. And as you can see, as the S&P was rising in December, its momentum was weakening and breadth was moving lower. More decliners than advancers. In fact, there was a 14 consecutive day period where the S&P had more declining stocks than advancing stocks while it was rising. So it was a little bit of an anomaly, but now you saw that the market, the S&P itself, exhibited some weakness, and so the index eventually followed the advanced decline line. It's in this channel. It's bouncing near the top of the channel. One good sign is that you can see that we have a green candle. The last candle, that was today's candle, was green. So it actually went up from the open to the close. There was some progress during the day. It gapped up because of the CPI report, but then it also continued to go higher after the open. That was the same for the NASDAQ. It's also in this channel. It broke this uptrend line. It retested it recently, fell pretty hard, hit the bottom of the channel. It's now moving towards the top of the channel, but it too made progress during the day. It opened up because of the CPI, but then it also went up during the regular trading hours, which is a good sign that there was follow through and additional strength intraday. However, if we look at small caps, now small caps have been really clobbered since Thanksgiving. And a lot of that is because interest rates have risen. They're, more sensitive to interest rates than larger cap companies. It's in this falling, broadening wedge, which is supposedly a bullish pattern. It was in one of those patterns in the summer, and it broke out here. It was at a little falling, broadening wedge here. It's not listed, but if you look, you can see that it was kind of the same, different angle, but same pattern, and we had this big breakout. So today it came up to the top of that trend line, and it got rejected. So it made almost no progress intraday, whereas the NASDAQ and the S&P made ample progress intraday in terms of going higher from the open. The Russell 2000, this is the index. If you look at the ETF, I think you'll see a red candle where it basically went down from the open. And if you look at the equal weighted S&P, this is an ETF as opposed to the index. This is what IWM would look like. It would have a red candle, meaning that it was lower during the day from the open. So the equal weighted S&P is in a falling, broadening wedge like IWM. The nice thing is it broke out of that wedge today because of CPI. That's bullish. But it made no progress intraday, and it fell back from the open to the close. So you basically had intraday weakness for the Russell 2000 and for the equal-weighted S&P 500, which is very similar to the intraday weakness that we saw all of December when those indices and ETFs were moving lower while the NASDAQ and the S&P were moving higher. So we might be back into that regime where large cap tech outperforms and the broad market kind of wallows, but that's not really a recipe for a sustained advance in the S&P and the NASDAQ either. So the S&P is not very far from its all-time high. Maybe you can go up and test that. Maybe the NASDAQ can also test its all-time high, but the small caps and the equal-weighted S&P, they have a bit of a longer distance to go. So we may have seen the top for those indices. One big headwind for this year and onward is valuations until the market pulls back pretty substantially to reset those valuations to something that's much more sort of attractive from a risk return standpoint. It's going to be a headwind. So here's our preferred valuation measure, the aggregate investor allocation to equities. It's basically at the level that it was at the dot-com bubble. At the all-time high of the S&P 500, it was higher than this, 0.527. It's pulled back a little as the market's pulled back. But this level is essentially forecasting a 10-year annualized return of minus 0.2%. And bonds are giving you 4.6, 4.7%. So the equity risk premium, you're basically likely to earn 4.8% more per annum holding the 10-year bond than you are holding large cap, the total U.S. equity market, let's call it, which is obviously weighted to the large caps. So that's not really auspicious for equities. Now, if we look at how composite equity relative sentiment is set up, in December it was bearish. It was below 50%. Equities fell. And notably, in December, our survey relative sentiment plus machine learning indicator was at 0%. When it's at 0%, when it's below 20%, markets tend to have problems. And I'll show you a chart explaining what I mean. But it bounced back to above 90 for January. And when it's above 90, market tends to do very well. So that's bullish for equities. The fact that composite equity relative sentiment is about 50% and that survey relative sentiment plus machine learning is at 94%. That's good. However, I should note that composite equity relative sentiment will be falling to 52% at the end of this week. Now, 52% is still sort of neutral bullish. Market tends to kind of go sideways, maybe drift higher when relative sentiment is between 40 and 60. So that might also suggest that equities, yeah, they could bounce, but maybe they're not going to go into a sustained uptrend and sustainably surpass the all-time high from December. Another thing to think about is that breadth was really bad in December. But when you have really bad breadth, that gives you an opportunity to have a breadth thrust. And the window for having the most famous and possibly the most effective breadth thrust, the Zweig breadth thrust, has elapsed. So we can't trigger a Zweig breadth thrust now. So that was an opportunity that was missed. And you would think that if the landscape was very bullish for equities, that you would get a breadth thrust given how bad breadth was in December. If investors were thinking, okay, this is just a temporary dip, we're going a lot higher, you would have a lot of money being put to work, you'd have a breadth thrust, and then you could expect another year of 20% returns. Every time the market had a substantial dip between 2023 and 2024, a breadth thrust was triggered. We didn't get one this time. So that's sort of like the dog that didn't bark. It's a little bit suspicious, a little bit of a red flag for equities. So valuation's a red flag. No breadth thrust is a red flag. Intraday weakness in the Russell 2000 and the equal weighted S&P, that's a little bit of a red flag. And we'll see there's some other red flags from other very important assets. But before we get off of that, here is how the market performs, both the total U.S. equity market and the equal weighted S&P, when our survey relative sentiment plus machine learning is either above 90% for the month or below 20% for the month. So the black and navy lines are when it's above 90%, and the dark red and orange lines are when it's below 20%. In December, it was at zero, below 20%. We had a big sell-off in December. It's like a stair step down. Now it's above 90. When it's above 90, the market averages 2% in the months when it's above 90. Its median is also 2%. So It's a pretty symmetric distribution. It's up, I think, about 75% of the time in the months whenever that indicator is above 90%. So far, the S&P is up, or the total U.S. equity market's up 1.3% so far this month. So we could be tracking to potentially, finish the month higher. Here we have our composite equity relative sentiment. As you can see, it was below 50 in December. It jumped up to 63 to start the month. We're up about 1%, but it's going to be pulling back to 52% this week. And so that might kind of put the brakes on the rally. We'll have to see. Here is something that's also maybe a bullish tailwind for equities. This is how the different investor classes are positioned in the futures and options market in equities. It combines the S&P, the NASDAQ, the Russell 2000. They're mini futures, they're micro futures. And as you can see, the blue is institutions, and they were very bearish in 2024 at some point, but they've been steadily increasing their aggregate equity position. Now it's below zero, so that's still bearish, but it's much less bearish than it has been. Meanwhile, speculators, the green, were extremely bullish right around the election time, and they've brought their exposure all the way back down to essentially zero, so they're neutral. So you have institutions that are tilted bearish, you have speculators tilted in a neutral way, and you have retail that was also really bullish, but they've pulled back. So they've pulled back, and institutions have kind of moved higher. So while overall it's still not a bullish positioning, you'd want to have retail below zero and institutions above zero, it's moving in a less bearish direction. It's moving, in a bullish direction. So that could possibly extend the rally. We'll have to see. But I think, and here's an indication of how the market tends to do whenever this orange line is whenever our composite equity relative sentiment is between 40 and 60%. This Friday it will go to 52%, which is between 40 and 60. And so, we might expect something along the lines of the market kind of being choppy. Maybe, it goes up a little bit, pulls back. But I, don't want to say we're not going to have a melt up, because I know a lot of people are talking about the equity market having a blow off top. I wouldn't rule that out. Of course, I don't think it would be sustainable, and I think we pull back pretty quickly. But given the orientation of composite equity relative sentiment, the odds would tend to favor choppiness and maybe a slight drift higher. Now let's move to the dollar. So the dollar is basically driving everything. The dollar has been up 14 of 15 weeks. It looks like it'll be down this week. So 14 of 16 weeks. Of course, there's 2 days left in the week. So it's Wednesday evening, 11:23 p.m. Atlantic time. On the East Coast, it's 10:23. So the dollar rises and other currencies weaken, and their energy costs, which they basically have to spend dollars to buy oil, those rise. In order to gather dollars for the oil, they have to sell their U.S. Treasury assets, and that's really weighed on Treasury yields. Now, before we move on to Treasury yields, you can see that the dollar has basically retraced this vertical drop here from November of 2023. That was when Yellen shifted the issuance of Treasury bills, of our debt, from the long end to the short end. She was issuing Treasury bills instead of coupon bonds, and the dollar weakened dramatically. We got that breath thrust in equities at the beginning of middle of November in 2023, and we had this vertical drop, and vertical drops and rises tend to retrace eventually, and you can see that it's basically retraced that entire drop. Now, here's a vertical drop too at 113, and people have said, hey, the dollar is going to 113. Now, if the dollar goes to 113, then almost certainly bond yields are not going to fall, and if bond yields don't fall, I don't think equities can really rise. Certainly, small caps can't rally. The equal weighted S&P probably can't rally. You might get, the mega cap tech stocks going crazy again like they did in early December. But again, that's not a sustainable, situation. So this is basically the linchpin here, the dollar. Does it continue higher or do we pull back? Dollar relative sentiment turned bearish here after being bullish from here. So it's been a little bit out of phase recently. It was bearish, dollar fell, but then it kind of went choppy. It got bullish here, dollar fell, but it stayed bullish. And then it turned bearish here, dollar kept going. So does this pull back? Smart money is still bearish, but they've been buying the dollar on a relative basis the last several weeks, and they're not too far from flipping it bullish if they continue to buy. So if they continue to buy, that would be a huge statement, and it wouldn't likely be auspicious for equities because, if the smart money is buying the dollar after it's had this big rally, they're essentially expecting it to keep going. And so maybe 113 is in play if that's the case. Here's our indicator, our composite, or our dollar relative sentiment indicator. You can see it's below 50%. That's bearish, indicated by this red segment here, but you can see the dollar has been moving higher anyway. So I think that would need to turn around for equities to rally. And also, as the dollar gets stronger, you're going to have translational effects for earnings. And I saw somewhere today where whenever the dollar rallies, you see fewer earnings beats, because when the overseas earnings, you convert them from the local currency back to dollars, you have fewer dollars. You would think that would be taken care of by the analyst estimates, but apparently it isn't. And so we might see less exuberant earnings season. Here we have TLT, 20-year bond. This has been going down in a straight line for the last 5 or 6 weeks. Today we had better than expected inflation, and all it could manage was a 1.5% rally after a 10% drop. So that doesn't strike me as too confidence building that yields are necessarily going to, TLT is going to rise and yields are going to fall at the same rate that the opposite move happened. And the fact that TLT couldn't make any intraday progress, it basically finished where it opened, and it dipped lower during the day as well. That doesn't really fill me with a lot of confidence that yields are going to come down in a consistent way. Now, the positioning is bullish, or in a configuration that historically has been bullish for long duration bonds. It turned bullish here and got a quick rally, but then again, it's been straight down the last 5 or 6 weeks. Barely got I would have expected a 2, maybe 2.5% bounce today if the market were really sure that inflation was going away. But the fact that it didn't bounce that much and it didn't make any intraday progress suggests that either the market is looking past this report. Oil went from the 60s to now it's above 80 in just a few weeks. So maybe the market's looking past this report, or maybe it doesn't care about inflation as much as it cares about, what Donald Trump's policies are going to be and what his Treasury Secretary is going to do in terms of debt issuance. If he's going to issue a lot of long-term debt, that will put upward pressure on rates, not downward pressure. So TLT isn't really out of the woods. I didn't even mention that the dollar, it sold off on the CPI report as much as about 50, perhaps 60 basis points right after the number was released. But by the middle of the day, it was positive again. So the dollar couldn't even hold its loss. It finished maybe down 10, 15 basis points, but it had been down a lot, and it did go positive again after it had already fallen a lot. So that, coupled with the fact that TLT made no intraday progress, suggests that the dollar and bonds aren't ready to reverse just yet, or it's not a guarantee that they will. Maybe we still have some higher dollar levels to see. Maybe bonds have to move even lower before they become a value play. But if that's the case, then I certainly wouldn't expect equities to make much progress on the upside from here. So here's the 30-year yield. It had recently broken through this resistance levels here, and I would think it would have to fall below those resistance levels to give some confidence that, yes, yields might be coming down back to, maybe this is 30-year yield, to 460, 450. 445 has been somewhat of an attractor the last few years. Maybe it could potentially get to there if it does fall through this resistance, which was probably not support. So until it does, I would think that equities could, still be in jeopardy of not, retesting the high, or maybe retesting the high but then rolling back over and making a lower low. So everything is revolving around rates and the dollar right now. Here's our composite relative sentiment for TLT. It's at one of the highest levels it's been at the last few years, but it had 7 signals in a row that were winners. It was bearish, it went down, bullish went up, bearish down, bullish up, bearish down, bullish up, maybe 6 or 7. I can't even count. 1, 2, 3, 4, 5, 6. 6 winning signals, and it's the last 3 have been washes. So this red one went sideways, this green one went sideways, this red one went sideways. Now this green one is going down, so this might be a loser. It better get its act together quickly if it's going to turn into a winner. Depending on what the smart money does in the dollar, if they stay bearish, then this signal will likely continue for at least a few more weeks. If they turn bullish, then the signal will turn to red. So that'll be something to watch. Let's move to precious metals. So precious metals composite relative sentiment turned bullish a couple weeks ago. It hadn't been bullish since the summer, and gold wasted no time. It's up a few percent. If you look at the chart of gold, it's basically testing this upper trend line of this pennant. So here's the last candle up here. Composite gold relative sentiment turned bullish here. It's been up since. Now, I think because the positioning is bullish for gold, I think that there's a reasonable chance that it can break through the top of this pennant. Probably a higher chance than if the positioning were bearish. However, it wouldn't surprise me in the slightest if gold fell down to the lower trend line of this pennant before turning back higher. That would be about a 3% drop from the current level. It wouldn't surprise me if that happened. If it doesn't fall back and if it keeps going, I think that would be a pretty bullish sign and probably an indication that gold is, resumed its uptrend and it's going to start to move higher. If we look at silver, silver composite precious metals relative sentiment is the same for gold and silver, so it turned bullish at the same time gold's did. It turned bullish here. Silver's up 6%. Since it's turned, it turned bullish at 30. It's at 31.74, so almost 6%. Again, if gold keeps going higher, if it breaks through that pennant, I would expect silver to keep moving higher. If gold pulls back, then I would expect silver to pull back. Now, if we look at how precious metals do when silver relative sentiment is bullish and dollar relative sentiment is bearish, which is the current case, you tend to see this, step function type of behavior. The flat areas are whenever we don't have bullish silver and bearish dollar relative sentiment. Whenever it's moving, we do. And you could see silver has kind of just had this stair step type of behavior when its relative sentiment is bullish and dollar relative sentiment is bearish. That's what we have now. This doesn't take into account the 6% move that silver just made. So again, it's kind of moving as this, historical behavior would suggest. But because we have such a stair step type behavior, whenever we have bearish dollar relative sentiment and bullish silver relative sentiment, that might be an argument for silver continuing higher, gold continuing higher in a perhaps violent way, catching people off guard because they kind of did lull people to sleep, moving sideways. Miners and silver moved sideways down since June. Gold moved higher, but it did pull back significantly from its highs. And, if people were buying those highs and then gold fell 7-8%, maybe people were blown out of those positions. They were probably getting, tired and irritated and annoyed by silver and miners, which were going nowhere and actually lower. So, that's why silver relative sentiment turned bullish. Retail was selling and institutions were buying on a relative basis. And so if retail is kind of thrown in the towel, maybe we continue to get a pop here for precious metals. The secular cycle certainly favors them. And speaking of secular cycles, this is just a reminder that we are in a secular bear market driven by high inflation. If you look, so just to refresh your memory about those definitions, in a secular bull market, equities on an annualized basis tend to outperform inflation by double digits. So inflation might come in at 2-3%, and equities annualize 12-13% over a 1-2 decade long period. In secular bear markets, equities just keep pace with inflation. They either don't beat it. In the 70s, from 1965 to 1982, inflation annualized at 7%. The S&P annualized at 5%. So it lost 2% on an annualized basis over 17 years relative to inflation. If you look since the end of 2021, the S&P is up about 25%. It was at like 4,800. It's below 6,000 now. If you throw in some dividends, it's up about 25%. But if you look at inflation is up 13%. So on an annualized basis, the S&P is annualized 7.7%, and CPI inflation is out annualized 4.1%. So the S&P has been beating, since the end of 2021, the S&P is outperforming inflation by 3.6% per annum, nowhere near double digits. And if the S&P pulls back 10%, it's no longer beating inflation. And 10% isn't a big pullback when you have valuations at all-time highs, when you have huge concentration in mega cap tech, which better grow into the earnings that people have been pricing in for them. And even if they do grow into those earnings, there's no reason for their stock prices to move any higher. It's already been priced in. So just a minor pullback in equities and inflation would be outperforming them since the end of 2021. Now, if we look at the assets that we would expect to outperform in a secular bear market driven by high inflation, this chart compares various assets since the end of 2021, December 31st, 2021. The candle chart that you can barely make out here is the total U.S. equity market. But here we have Bitcoin strongly outperforming, XLE, best performing equity sector. You have gold, you have metals and mining, ETF, XME, you have GSG, which is the Goldman Sachs Commodities Index. They're all outperforming VTI. The only ones that you would expect to outperform that aren't are the material sector and emerging markets because they're commodities linked. But China's been not doing so well. However, we're still early in the secular cycle. We have at least until the end of this decade, possibly another 10 years from here. So there's a long time for materials and emerging markets to get in gear. But this does suggest that we are in a secular bear market driven by high inflation because the assets that you would expect to outperform largely are outperforming. And to kind of wrap it up, here's commodities. So they were in this pennant. At one point, it looked like it was a descending triangle, which would have suggested it was going to move lower, but it looks more like a pennant here. And they were in a long-term secular bear market while the tech stocks were going crazy in the 2010s. But that secular bear market ended when crude oil went negative in April of 2020, right in the wake of the COVID sell-off. It's been on a rampage ever since. Secular bull market. Russia invaded Ukraine, and then Biden suppressed oil prices in a chance to get reelected, keep inflation low, temper it so the Fed could eventually lower rates in time for him to win re-election. And that seemed like it was, a plan until he, got blown out because he's senile. And so that didn't work out too well. And he did suppress oil prices pretty well. But now on his way out the door, he is basically putting sanctions on Russia, which is causing oil prices to rise. But that's what we would expect in the secular bull market for this pennant to break out to the upside. Now, I'm very cautious and I wouldn't declare that, the uptrend is definitely back in gear. This could potentially be a false breakout and it might come back down here. But ultimately, in the secular environment that we're in, we should expect it to resume the uptrend at some point. This might be that time, but I would think we would need to see it rise, a little bit more from here before we can definitively say that. This still could potentially be a false breakout. If we look at energy stocks, they had a really rough December. They were down, I think, 10, 11%. They're having a good January. They've recovered, probably 70% of that. And again, we would expect them to continue to be one of the best performing sectors over the next 5 to 10 years. And if it can break, these highs here, which were the all-time highs, it's probably off to the races. So just to recap, equities probably can't go higher unless yields fall. Yields can't fall unless the dollar falls. The dollar probably can't fall unless inflation moderates. Yields could possibly fall if we have a growth slowdown, but if we do, that probably won't be good for equities either. So yields have to fall because inflation's moderating. Otherwise, equities are going to have some trouble. We saw some red flags today. TLT made no intraday progress. Small caps, equal weighted S&P, actually, regressed during the day. So that wasn't auspicious. And the dollar pretty much finished flat after trying to sell off. So, unless the dollar can sell off and yields can fall, because inflation's moderating, broad equities are probably going to have a hard time. Maybe mega cap equities can carry them again, but that's not a sustainable situation, and that will eventually unwind itself. So that's all I got. Thanks for watching.